Hello and welcome to the Total Wealth Academy podcast. I'm your host, Steve Davis, where I try to bring you quality individuals that can share their knowledge to help you understand real estate investing better. Today, my guest is Sam Morris. Sam Morris is an accomplished apartment investor as well as self-storage. He may have done some other things. He's going to talk today about why now is the time to strike, why now is a great time to be in the real estate market. So, Sam, welcome to the show.
Thanks, Steve. Great to be here.
And you were looking at properties this morning?
I was. It's a never-ending game, right? So
That's the truth. It's like as soon as you find one that you want to buy, you really have to begin looking for the next one. So
yeah, we're very fortunate. We have a great team that I get to work with, and so we've, when things get exciting or when they see something that they really want me to go take a look at, I get to go out there and go take a look. So it's awesome. So.
All right. Well, I'm going to turn it over to you. I'm not going to interrupt you during your slides. We'll have a little question and answer at the end. So it's yours.
Awesome. Yeah. Today, I wanted to talk about why now is a great time to invest in real estate, and specifically multifamily real estate. See if I can get this to go. Oh, yeah. As a disclaimer, I'm not an accountant. I'm not an attorney. I'm not a financial advisor. For anybody who's looking for that kind of advice, you need to go to those specific people because your specific situation is going to be specific to you. So this is kind of a broad educational overview of what we're seeing in the market really today. About myself, I've been in real estate in some form or fashion for about 25 years now. I've led acquisition and disposition teams in multifamily of about $700 million of transactions. I am a sponsor and a member at Total Wealth Academy. I'm also a former banker. It's actually where I got started. And so I kind of cut my teeth early on, really underwriting all these deals and learning the quantitative side of the business. And in doing that too, I got to be a lender on almost about $1 billion in real estate transactions locally here in Texas. Banking's still in my blood. I'm currently still a director at Texas Traditions Bank. And so I get to stay involved in that world. Just a little taste, and it's wonderful because I get a lot of education and a lot of great data from it. But my current job is a partner at LSCRE, where I get to be involved in our acquisitions, our asset management, and investor relations side of the business. And I love to just continue to drive that strategic growth, delivering those strong returns to our valued investors. I've been married for 22 years to my wife, Christy. We have 4 children. 2 of my boys are Aggies, and they are 20, 18, 16, and 14. I know that's a lot to say right there. Our company, at a glance, though, we were founded in 2018 by our CEO, Rob Beardsley. We've gone full cycle on 2 deals, a little over 25% average annual return on those. Our current portfolio, as it sits today, is a little bit over $860 million, and that's just shy of 6,000 units, all here in the great state of Texas. We do monthly distributions and monthly reporting. We have over 200 employees, and the supermajority of which are on-site staff. We've had 0 losses or capital calls through the life of the company, and we have over 400 repeat investors. So a quick snapshot of our current assets and track records. You'll see the bulk of our assets are located right here in Houston, Texas. And this is kind of how I wanted to start. We're going to get into the meat of it right here. Be fearful when others are greedy, and greedy when others are fearful. It's a famous quote by probably one of the greatest investors of our time, Warren Buffett. And I have this chart up because, Warren is actually somebody who really shows what he's going to do. Berkshire Hathaway shows what they're going to do. And when you look at this chart, right, it actually shows the amount of cash that they hold as a percentage of their assets. Not just the dollar amount, because they've grown in dollar amounts over the years, but I've gone back almost 35 years in this particular case. And they are now holding the greatest amount of cash that they've ever held in their company's history. And what that means, and what that's telling us too, is that they see that the value of the stock market is a little bit overpriced. And one of the ways we can actually know that that's the case is we have something called the Buffett indicator. This is actually a true dynamic indicator that we look at. The Buffett indicator right now is actually, and I actually looked this up recently, it's actually closer to about 240% right now. What that is it's the market cap, right? The value of the stock market as it compares to the GDP. And anything over 135% is actually considered a strongly overvalued equity as it relates to the economic output. And so this is one of the things that Buffett he created years and years ago, but this is what they've looked at to see where we are from a valuation standpoint to the market. And so it created a little bit of a multifamily thesis for us. It said tangible multifamily assets can really provide a hedge against whatever equity bubble may be out there. And so there's a lot of people saying, hey, AI is a bubble, tech's a bubble, whatever it may be. And I don't really know, but I do know that there is a hedge opportunity with multifamily right now being in stable, multifamily assets that are required for housing. And this came up because I talked to an investor not too long ago, and the gentleman was actually about 70 years young, very sophisticated. And he had told me when I talked to him, I said, hey, yeah, multifamily cap rates right now in Houston are probably about 5.7%. I was telling him that was kind of the average across all the multifamily. That's A class, B class, and C class. And I had some data to back that up. And he came back to me and said, well, I'm not going to buy any real estate or any investment for that matter below a 6 cap. And I just said, okay. I go, so where are you putting your money? Which is kind of a common question we would ask. And he said, I'm putting my money in the S&P 500. And I said, oh. I said, well, I asked what the PE ratio was for the S&P 500 to him. And he actually quoted me the CAPE ratio, this is now actually over 40. And he told me the CAPE ratio of the S&P 500. Again, this is a fairly sophisticated investor. The CAPE ratio is another way to do the PE ratio. It actually takes in a little bit more historical earnings with it. And when he told me that, I said, oh, well, so you're okay paying a 2.5 cap on your S&P 500, but you won't pay less than a 6 for residential or for real estate? And he paused because at that point he said he had never been talked to that way. Nobody had ever explained it to him that way. And I said, well, let's look at this because the ratio has not been, it's only been this high one other time in history, going back to actually, prior to 1929. So 1929 crash, the 1987 crash, it was never this high. It's only been this high at the 2000 .com crash, where we sit today. And so with that, it gave me some way to talk to him and say, are you sure what you're doing is what you're actually trying to get done? And coincidentally, he actually ended up investing in the deal with us when we were talking about it. But what this did was I said, well, look, let's look at these things side by side right now. And when we did that, I said, we'll go through it. If you look at over a longer period of time, annualized returns for the S&P 500 versus multifamily real estate, well, multifamily wins, right? If you look at the volatility, because that was something he was actually really concerned with, was the real estate has gone up and down, especially in the last few years. We've seen some negative volatility associated with it. Well, when you stretch that out over a longer period of time, the volatility is actually much less in real estate than it is in the stock market. They can have massive swings up and down depending on the day. And if you look at the risk-adjusted return, which is the Sharpe ratio we used, it's considerably better in multifamily as compared to the S&P 500. But if you're looking for something that's going to correlate with the market or correlate to equities, the S&P 500 is actually the perfect investment for that. And I'll actually caveat one more thing with this too. If you're looking for liquid investments, right, the S&P 500 wins there too, because most multifamily real estate or real estate in general is going to be considered illiquid. But if you're looking for tax treatment too, it's hands down multifamily and almost any real estate is going to win compared to the S&P 500. And so when we went through all these things, it was look at what your alternatives are. And, the S&P 500 has been something that's so heavily been talked about and is now being more cautioned about. And these are some of the reasons why. It's because you're starting to see valuations that are, outsized compared to what we've seen historically. Whereas multifamily, we're seeing it at a point that's maybe a little bit different, where you're seeing it much lower than what we've seen historically. And so it's kind of given us that, hey, let's look at this compared to that mentality. And we've backed it up with all the data, but this was something we wanted to talk about just briefly because the stock market isn't the only alternative that's out there for investors. And so there are a lot of other alternatives out there. We just happen to believe multifamily is one of the greatest ones out there, and it wins in several categories, especially over a long period of time. But specifically, let's talk Texas. And we say, why are we so bullish, this great state, or as fellow Texans say, this great country, right? And it's because of a lot of things, but we're going to get into it in the data associated with it. So first, you look at what's happening here in the state, and anybody that lives out here has seen this. The domestic migration has been tremendous. And so people are moving here from all areas of the country. And their data backs it up too. So U-Haul has pretty much said, hey, Texas, you still claim the crown. Houston in their world has been the number 2 national metro growth. So they're seeing it just jump. And they're saying for the last 8 years, or for the last 10 years, 8 of them, the most amount of people have been moving to Texas. And that's that one-way traffic. And it's not just U-Haul. Penske's come out and said the same thing. They've actually added a little bit stronger where they say, hey, 4 of our top 10 spots are in Texas, and Houston is clearly the number 1. It's been the number 1 for the last 5 years. And so they're saying people are moving here domestically, and these are the one-way truck rentals, meaning people are getting a truck from somewhere else and they're moving to Texas and staying here. And Houston's been their number 1 spot. San Antonio's been number 3, and then Austin and Dallas are 7 and 8 respectively. And so the domestic migration has been tremendous for this state. You're seeing it being one of the top destinations all across the country for where people are moving. But that's only part of the story, because you're also seeing the foreign migration landscape still huge in Texas. And what's really unique about this, if you look at the most recent data we have right here from 2025, the number dropped by more than half. We actually had a 54% decline in 25 from net foreign migration, right? And a lot of that can be attributed to maybe some legislative changes or the administrative changes that we've had, but you're still seeing a pretty steep decline nationally from foreign migration in the last year and a half or so. That being said, it's still tremendous, right? And so Florida and Texas are right there, but Texas has had 167,000 foreign migrants move into the state in 2025, and the number is still large for 2026. So you could have an understanding of what that actually looks like, though. Of that 167,000 people coming into the state, that represents 40% of the growth, 42% of the growth. So we still have tremendous amount of domestic migration coming in. And you want to know why they're moving here. Well, they're moving here because of jobs. The foreign migrants in Texas now represent 1 out of every 5 jobs. So the total Texas labor force, 22.2% of them are from another country, right? And it's outsized roles in a lot of critical fields. And so we'll talk a little bit about that, about what we're seeing in the medical realm, in the engineering realm. And so the foreign migrants that are moving here, these are actually high educated people who are adding a lot to our communities, both in diversity and in knowledge. And so it's one of those things that it's actually a very great thing of the way we're growing our state. And it's a global hub, right? The jobs are actually the big thing. If you look at this year, actually, they're saying this year we will surpass 3.5 million jobs just here in Houston. And so despite whatever you may be hearing in the news, the national headwinds or things like that, we are still leading the country in job growth, and it's a major driver for why you're seeing people move here. And so you're seeing things in healthcare, you're seeing things in tech, construction, and energy, and things like that. A major amount of people moving here for these jobs. And the jobs isn't just right now. It's actually what's on the horizon. Because one of those things is that construction jobs that you see, it's because we're expanding here as a state drastically. And if you look at what's happened right now, 2026, they're saying we're going to hit that 3.5 million job mark. But if you look at what happens out to 2030, it's in this case, it's another 250,000 jobs that we're going to add in the next 4 years. And that growth outstrips almost anything that we've seen anywhere else in the country. And when you have a lot of jobs coming into a specific area, you will have a lot of people moving into that area for those jobs. And when this occurs, you have what's called our kind of supply-demand reset. So if you look what's happened in Texas, we're part of the Sun Belt, right? And specifically in Houston, right? We absolutely had overbuilt. So there was a supply glut that we ended up having. We ended up having for the last few years. And in 2025, we actually had vacancies around that called 11.5% range. So we had occupancies right at that 88% range. And right now, because of the trending of what's happening in this city, they're actually seeing that number trend down. So the occupancies are starting to go back up. And so the projections right now are that occupancies as a city are going to be closer to 91% by the end of 26. And because you have this pivot, right, and the supply demand balance kind of coming back into play, all these jobs coming in, coupled with the fact that there's no new supply coming on or very little supply coming on, it's leading to organic rent growth. And so where you're seeing this organic rent growth, right, that's where it gets us really excited to be investors into multifamily. And what does that look like? Well, if you look at this, I have a couple of these slides, different sources too. This is from Yardi and Moody Analytics. In 2025, the rent growth was actually negative. As a city, we actually have negative 0.9% rent growth. So the rents were lower last year. This year, and it's actually going to be more accelerated towards the tail end of this year, we're actually projecting a 1.2% rent growth, right? It's nothing to scream home about, but it is growth, right? And compared to where we've been the last few years, it's something that's actually a huge welcome sign for a lot of owners and operators out there. But this is where it gets really interesting. That supply cliff that we were talking about and this drop in completions, it hits Houston harder than most because we have a high now job to permit ratio. And so what that means is for all these jobs that are being created and the people that are moving in here and us not having the supply, well, what happens when there's greater demand than there is supply is the rates end up going up. And right now, those projections for the next several years outstrip just huge numbers for Houston. It's been a long time since I've seen anything that suggests a 4% rental increase in Houston, right? And so right now, if you look at what's going to happen according to next year, 2.8%. We would actually say that's probably about where a normal year should be for Houston. It's where a lot of people model their outputs when they're doing their deals, right? And so if you look at that growth, and it has a tendency to grow even greater than where most people are modeling, the returns become outsized compared to what syndicators will show you what it's going to happen on their deals. And so here's another way of looking at it. Currently, in 2026, the average effective rent in Houston is $1,410. That's where we are from a dollar perspective. If the numbers keep hitting like what I showed you earlier, by 2030, those average rents, changing nothing from an effective standpoint, go up to $1,670. It's a pretty large jump, and most people do not project those kinds of returns associated with just their rent. So you're seeing an acceleration from concessions burning off and actual increases because of demand coming up from a supply perspective. All right, here's the same thing we just talked about, just more in a form that's easy to kind of see. 2025, we had rent growth negative 0.9% with that 11.5% vacancy. We had new deliveries in 25 of about 25,000 units. That's actually about an average year for Houston. But we had job growth of about 42,000 jobs as well. 2027, which is next year in a forecast, they're projecting rent growth of about 2.8%. The vacancy now goes down a little bit more. We have about a 91% average occupancy, but this is where the story gets interesting. The new deliveries, 12,000 units, far below what is normal or average for us here in Houston. And the job growth continues to grow. 58,000 new jobs would be delivered that year. 2030, 4.4% growth. And part of the reason you're seeing that kind of growth is the vacancy has dropped even further. We're running right at that 93, 94% rate of occupancy. The new deliveries tick up again because once the jobs continue to grow like this, there will be more starts in the next few years. They have to, just to keep up with the demand. And you can see that job growth being 65,000 jobs that year. So when you see all these things and this tightening of the market, creates that organic rent growth, it will also create eventually more builders coming into the market to deliver the units. And so you'll see an equilibrium eventually begin to occur probably sometime in that 2031 plus range. Affordability has also been one of the unique things. Houston is by and large been considered an amazingly affordable area to rent. Our rent to income ratio here, I think, is about the third best in the entire country for the major metros, right? We're right at that 20% number, meaning your rent to income is running right about 20% on average for the whole city. However, ownership is a little bit different. And we took these numbers from HAR, which I think they're even a little bit lower because they're saying their estimated monthly outlay for a home, a median home here in Houston, is about $2,400 a month. And that's principal, interest, and taxes, and insurance, I should say. Whereas an apartment rental, average apartment rental, your typical 1 to 2 beds, is about $1,300 a month, $1,300 to $1,400 a month. So you have anywhere between $1,000 to $1,100 a month delta. But really, where the big information is the minimum income needed to afford a median home here in Houston and qualify for a loan. The baseline income that is needed is considered to be $96,000. That is far greater than the median income for Houston right now. To have that same person do a rental for an apartment, the median income drops to $54,000 a year. So it is drastically different, much more affordable to rent an apartment and live here. This is where your job's going to be, than it is to go and try to purchase a home here locally. Some of the catalysts that we're seeing between now and 2030 is you have the employment lead. Houston's still projected to lead the country for employment. And because of that, you're going to lead the country with population too. And so we're seeing that between now and for the next several years, Houston will be the spot to be, both from a job perspective, a living perspective, and an investment perspective. That affordability gap is still there. So it's become really easy to rent here from a cost perspective. It's much more affordable than it is in a lot of the other areas of the country. And we still have these jobs, TMC expansion. You have Apple and NVIDIA who are building their AI supercomputer factories on the northwest side of town. That's being done this year, bringing 3,000 jobs. There are more things going up all over this city, as big as the city is, right, that are leading to just great value that we're seeing right down here in Houston. And so a lot of the brokerage groups came together and they said, hey, here's our outlook and underwriting. We kind of condensed this together. They see for, the next few years that target IRR for, investors coming in, assuming that standard 5-year hold deal, somewhere in that 13.5 to 15.5% range. Meaning if you're going and buying something, this is kind of where we feel you should be able to make good risk adjusted returns. They do still see that cap rate right now being right about 5.7%. And so that's kind of the average across A, B's, and C's. And the way I would define that is, A's are going to be a little bit lower than this, maybe in that, 5 to 5.5 range. B's will be in that 5.5 to 6 range, and C's may be in that 6 to 6.5 range. And so kind of across all the classes, that's where they're at. They still see Houston as the number one job creator in the country, and still think that this is the place that's going to be, and that the demand is going to continue to increase, and that it provides just an amazing opportunity for the investors who are here. And this is kind of our window of opportunity. And then I'll shut up for you, Steve, and we can talk. But population growth is going to be the highest in the country. Job growth, highest in the country. The supply has gone off the cliff, as we've said, for the new units that are coming. The rent growth is projected to be really outsized for the next several years. Replacement costs are so much easier to buy than to build, because it's so much cheaper to buy what's something existing than actually build something new right now. And it's about 30% right now. And the returns that we're starting to see are projected to be very strong in kind of an unstable, equities market that we're seeing in environment. And so, when you're looking for something that's a delta or alt compared to what's going to be available in the general market, this is something that we're seeing that gives you a lot of risk-rated return compared to what we're seeing in the market. And liquidity is finally coming back into the market. We've already seen, major players, institutions, and things like that. They're coming up and they've been buying up the lion's share of the A-class plus properties that we're seeing in Houston. And I know because we compete against many of them out there, and they have major discretionary funds to be able to do that. And that is what I got to talk about, Steve, in my, quick amount of time to get this done. But I'd love to hear some of your questions associated with it.
Well, I don't think I have any questions about what you covered. It really sounds like Texas is the strongest place to invest. We have a lot of sponsors in Texas at Total Wealth Academy. So that's a great thing. But we've got a lot of sponsors or syndicators out there that bought property with adjustable rate mortgages. Those are starting to come due. We also had a lot of people that were buying just a few years ago at high interest rates, and their deals are not cash flowing. It seems to me that one of the things that's going to happen is a lot of these people are going to sell, and some of them are going to be forced to sell. A large group will be forced to sell, and then a lot of them, because of that high interest rate and just their money sitting there, they're going to want to get it out of certain deals and into something more profitable. What's your opinion on that? Is that going to help reduce the cost of these apartments?
Yeah. So, I mean, I don't think it's a surprise. If you acquired a deal, say in 21 or 22, you probably bought where we kind of, I guess, where we kind of seeing was maybe more the higher part of the market, and how you finance matters. So, if you were buying with adjustable rates and things like that, you're going to see some more people that are pushing through some of the distress. And that looks in a lot of different forms. So you can have financial distress that way. You can have property distress, the physical distress, and then you can have operational distress or partnership distress. So you can see a lot of the different things that are occurring throughout the market. And it really is, it's really going to be, it hadn't been as big as what we thought, meaning, everybody thought, oh, we're going to have these major discounts and we're going to be able to buy things. And you're starting to see some people definitely can get some discounts on some deals, but it's not as large as what we were anticipating, because there's still a lot of value there. There's still, demand for the product. And it's really just, hey, if I'm going to finance this way, this is how I can make good money on it. The person wasn't in the same situation. And so, we may be a little bit off from our bid ask spreads, but it's not as wide as what people have suggested. When we're going out there looking for deals, and we look for higher quality deals, but the bid ask spread difference really isn't as wide as a gap as what most people think. But are there deals that were acquired in the last few years that they're going to have struggles, they're going to have loss, that does need to be reset? Yeah, there absolutely is some of that going on out there. And it's more of a, where's the best spot for your capital today? And this is what we're seeing. I mean, it's truly opportunity to buy in at a great basis, to kind of ride that wave back up. It cycles just like anything else. And so the way that works is, if you invested in those times, and let's just say you don't get full return of capital or something of that nature, I mean, pushing that money back in, or reinvesting to try to get at a lower basis. We always talk about it from the perspective of, man, if you like this property at, let's just say it was 150,000 a door, right? And the same property is now going to be for sale for $125,000 a door, and it's making more money. Does that not look more amazing to you? And
Yeah.
and it's kind of a cold way to look at it, because I keep telling people, I said, look, if I bought Apple stock, let's just say at $300 a share, and today it's worth $200 a share, and I look over here and I see Nvidia at $200 a share, and I think Nvidia is going to go to $1,000 a share, would I sell my Apple to go buy Nvidia? And the answer is, yeah, absolutely would. But there's some kind of hang up of going, all right, well, I paid 300, I don't want to sell for 200.
Yeah.
But if there's an opportunity out there that you can go make a lot more money on it, it would make sense to do. And so we're seeing a bit of that too in the market. And so, I try not to be cold about it, because it's more truly about the numbers for me. But if that occurs, it's not the end of the world to go, all right, hey, let's free up capital and go take advantage of another great opportunity. We didn't hit it on that. And that's the longer term investor mentality that a lot of people need to have when they come into these types of deals.
Certainly. And it's very sad that certain people do have that mentality that, hey, if I don't sell, I haven't lost the money. If Apple goes from 300 to 200, yeah, but I didn't sell. No, the 100's gone. You got to face reality, sell it, go buy something like you described that's going to go, that is going to go way up, and get your money out of that before it's too late. Okay, Sam, I sure appreciate it. Thank you so much for coming on the show today. For those of you listening, we have free events where you can meet people like Sam, as well as other investors like yourself. check out totalwealthacademy.com. We offer a free sample class so you can see how our educational program works so that you can become a sophisticated investor. So check that out at totalwealthacademy.com. Thanks for watching. Have a great rest of your day.